I'm a partner in our financial institutions group, and I get the pleasure of introducing our speakers and emceeing today. As you may have noticed, we are live streaming this event for some of our clients and friends who would have had to travel a little bit, those from Montana and Maine and elsewhere. So we want to welcome them as well. And also, we are being live streamed by Bankers Hub. I don't know if you know about them, but Mike and Aaron are in the back, and we want to give them a shout out as well. So they're helping us with that. So, and the fact that we're live streaming, we want to try and stay as much on time today as we can for the benefit of those that are watching remotely, so that we can keep within those time frames. So I appreciate your assistance in advance for that. A couple of quick housekeeping items before we get into our introductions. There are some handout materials on your table. There's some agendas, speaker bios, and so on. One thing about the speaker bios, we actually had a couple of speaker cancellations due to an emergency. And I shouldn't say cancellations because we filled those spots very well. So we'll get into that as we go through the introductions. But Jeff Tobe in particular was our keynote speaker, and he had an issue yesterday that came up. So. But anyway, like I said, we've got a great fill-in for that. So there's also CPE credits if you need those. There's a form on the table. I'll be giving a keyword at the end of the session for those that need it, end of each session, and you'll have to write those down and leave those on your table at the end of the day. We'll collect those for continuing education credit. We did not produce handouts for this. If you want handouts, you can put your contact information on the evaluation form and leave that, and we'll provide you electronic copies of those as well. We also have some information on our upcoming events for those of you that are interested in looking at some of those down the road also. So with that, I'd like to start the session with our first speaker. The title of the session is Economy Good But With Caveat, presented by Dr. Elliot Eisenberg from Graphs and Laughs. Dr. Eisenberg is a nationally acclaimed economist and public speaker specialized in making economics fun, relevant, and educational. Dr. Eisenberg earned a BA in economics with first-class honors from McGill University in Montreal, as well as a master's degree and PhD in public administration from Syracuse University. Dr. Eisenberg is the chief economist at Graphs and Laughs, an economic consultancy that serves a variety of clients across the U.S. He writes a syndicated column and authors a daily 70-word commentary on the economy that's available if you'd like to receive that every day at www.econ70.com. Now I'll tell you, I personally subscribe to this blog, and depending upon where I think the economy is going, I'll decide if I read it right before I go to bed or when I get up in the morning. But it's very short, very sweet, educational, and once in a while, believe it or not, there's a little humor in it. So anyway, with that, please help me welcome Dr. Eisenberg.
You're welcome. Good morning, good morning, good morning. It's a pleasure to be here. Where do I start? I didn't look at my Twitter feed this morning, so I don't know what's going on in Washington, D.C. right now. I don't know the latest on Rod Rosenstein and all that sort of stuff. But I do know there's a lot going on with the economy. I mean, there's a lot of stuff going on. And I want you to think about the economy like this. I want you to take your brain and split it in half. I want half your brain to be present-focused and say, wow, things are good, enjoy it. I want the other half of your brain to be forward-looking, 15, 18 months, 20 months forward. And I want it to say, things ain't gonna be so great. I'm not predicting a recession here, don't get me wrong. We'll have one, of course. I have no idea when. To predict a recession, you have to predict something going wrong. There are like a million things that could go wrong. Emerging markets could knock us down. Last month, we could have had half a dozen things that wrecked our economy, right? So you have to have bad luck and bad timing all at once together. We'll have one of these days. But what I will talk about is when I think the probabilities of the recession begin to rise to something resembling a level that begins to warrant concern. We're not there. Things are really quite good now. Things are very good. Let me explain why things are good, and then we'll discuss why things aren't so good, and we'll put it together, and it'll make sense, and it'll be a plausible, realistic expectation of what's going to happen. So look, this is GDP, right? You all had some horrible class in high school or grammar school that talked about this. You forgot it. You hoped you'd never see it again. The first term is C, household consumption. It's great. It's not good. It's great. We're creating 2.5 million jobs a month, almost. We're creating good, decent wage growth of about 3%. And with these new people entering the labor force, 2.5 million, that bumps wage growth to 5%. That gives households ample spending power. So households have what to spend with. That's great. Partly it's wage growth, partly it's increases in employment, partially it's tax cuts that have increased our incomes, right? Cut our taxes, we have more money every 2 weeks. The second term is I, corporate investment in plant and equipment. And it's going up too. Firms have no people, right? Tax policy has changed. It's now more favorable to depreciate assets rather than expense them rather than depreciate them. Workers are getting more expensive. Healthcare is more expensive. Oh, we can't find workers. Let's buy some machines or equipment or build some plant because that's the only recourse we've got. So you've got strong C. You've had it for a while. Now you've got strong I. Normally, when you have both strong C and strong I, you don't need strong G. Last year, what did government do? The government cut taxes, right? The Republicans pushed tax cuts in December. I'm going to tell you that was a policy error that we may come to regret, and I'll tell you why. But right now, we're experiencing the high of it. But we didn't stop there with G, with strong G. What happened beyond that was in February, they had spending increases that were 100% deficit financed, $400 billion over 2 years. 75 billion, 150 billion of that 400 billion was for defense, 150 more was for social programs, and the other remaining $100 billion over the 2 years was for hurricane relief for last year for Florida, Texas, and Puerto Rico. That's very stimulative. We're enjoying the peak stimulation of that effect as well right now. So we're having a fiscal high from both of these policies right now, but it will die down. And we didn't really need it. You had to help the hurricane people, I understand. But the tax cuts and the other increases in spending that were deficit financed are ill-timed because our economy right now is already firing on all cylinders. And when an economy is firing on all cylinders, you don't want to overstimulate it. Because if you overstimulate it with massive fiscal stimulus, which is what we're experiencing right now, you end up with increasingly contractionary monetary policy, which is what we're getting now. So you complain, oh my God, rates are going up, it's going to wreck the economy. Well, we can argue whether that will or not, but we can all agree that the reason the rates are going up is because of the fiscal stimulus that occurred last December and February. So the G thing here, that's the very stimulative G, is unusual and arguably inappropriate, but that's besides the point. No one called me up. The last time we had strong G with strong C and I together was 1986, and before that, 1966 under Lyndon Johnson. So this is a very rare occurrence. Both of those, the Lyndon Johnson, of course, was Vietnam. These are unusual circumstances, right? Last but not least, there's exports minus imports. They're going to decline. In Q2, where GDP was 4.3%, I mean, that was just a rocking quarter, Q2. Among other things, weird one-off things, soybean sales were spectacular. Soybean sales boosted GDP by over 1 percentage point. So that's a one. It happened 3 or 4 years ago. We had a weird quarter also like that. We're done with that. This quarter, it'll fall. Last quarter, so Q2 was 4.2 or 4.3. Last quarter that just ended, probably 3.5. This quarter, probably 3.3. So strong growth, but not like it was in Q2, but all very good, no problems. Why am I happy? Look, the stock market's good. You own stock, you own a house, you own some real estate, you own almost any financial assets. I guess maybe not some long-term bonds. They've been hit kind of hard with long duration, but otherwise things are very good, right? The economy's humming, people's wealth is good, total household wealth cracked $100 trillion. We're a happy bunch of people. All our assets are doing well, so we're spending money. The wealth effect is real. It's dampened, but it's real. It's dampened because we're older than we were 10, 15, 20 years ago in the last booms. When you get older, you spend your money more reluctantly. And we spend our money more reluctantly because we went through the Great Recession of 2008-9. So we're a little more conservative in our spending patterns. We've all become more Midwestern, if you will. You are the ultimate in fiscal frugality and conservative behavior fiscally, right? We've become more like you on the coasts, right? The market's good. But I'm not totally happy with the world either. If you ask me what's going to cause the next recession, I don't know, of course. I think monetary policy probably will. But it may well be aided and abetted by this: a lot of corporate debt. This decade of virtually free money has warped behavior. And you can see this warped behavior in Sears. Sears just declared bankruptcy. I don't know what took them so long. They should have declared bankruptcy 5 years ago. They've done nothing for anybody for 5 years. That real estate's better spent some other way. Sears is, or was until last week, a zombie company. And this low interest rate environment allows zombie companies to survive and do nothing useful except waste money, right? And it allows other companies to borrow excessively at very low rates. As rates go up, this will cost as they refinance more money and so on. So this could be a problem down the road. We'll see. That said, people are very happy right now. You can see borrowing levels are going back up. They're today slightly higher than they were at the peak before the recession began. At the time here, what was driving total debt wasn't any of these things. They're all listed here. It was mortgages right there. You could see this massive run-up in household debt for houses, buying a primary res, right? My favorite, or one of my favorite rock groups is AC/DC. And one of their best songs is called Highway to Hell. It goes, Highway to Hell. That is the highway to hell. We're on it. We're driving. We're having a good time. We're smoking weed and going off the friggin' cliff. Completely irresponsible behavior by everybody involved. Appraisers, lenders, builders, bankers, real estate guys, securitization companies. Everybody collectively jumped in, drank the Kool-Aid and went crazy. Look now, mortgage debt's going up, but it's low. The slope is very weak, flat-ish, and today's totals are less than they were back then. There's today less than they were. Are there housing problems? Myriad housing problems, but there's no credit problem out there. FICO scores haven't deteriorated. Super easy, liar loans aren't out there, and so on and so forth. The other thing to notice is student debt. It's gone from nothing to huge. This is delaying millennials. So millennials, the key thing in life for a millennial, I'm talking to you guys because you're older guys and you're in front. They want to buy things, a house and stuff, and get going. They also want to buy a tattoo, but they can't afford one because their student debts are so big they don't have the $100 to get a tattoo right here, independent banker, but whatever. So, but they're getting their life together. It takes them longer because they got a car payment of $400 a month, a student loan payment of $400 or $500 a month. That's a lot of money. I mean, for you, it's just your pot tab for a week when you fly to Colorado or something, right? But for a 22 or 23, 24-year-old, that's a great deal of money. So it delays them, but they'll get there. Total delinquency status by these different asset classes is pretty good. Total delinquencies are way down. They're almost back to, they're back to where they were then. They're not quite as low as they were back here at the trough, at the very lowest level before they ramped up. They're still higher than that, but they are continuing to decline, but not a lot. And here's why. Have a look. Student loans have seemed to flatten out. I'm not sure what the real default rates are there. They lie a lot with the data, and since we pay for it, who really cares, right? I'm joking. It's $4,000 a person. Enjoy your contribution to society. You can see credit card numbers are going up, and you can see auto loans are going up. Everything else is still declining. We're late in the cycle. What am I going to tell you? I'm going to tell you to be careful. I'm going to tell you not to take undue risk at this juncture. A recession is coming around, whether it's a year from now or a year and a half, I don't know, or 2 years, but it's much closer than it is further away. 5 or 6 years ago, the economy was not rocking. It was growing 2.25%. But we were unlikely to have a recession because we had relatively recently come out of a recession. But now we're pretty far from a recession and GDP starting to cool from a very high level. Late in the cycle, interest rates rising, GDP going down. This is the classic textbook situation leading to a recession. Doesn't mean it will happen. I still don't know when it will occur, but you're more likely to have it happen. I want you not to loosen your lending standards right now. Probably not the best thing to do. You have your best clients, you know they're responsible, okay, you can give them the extra money or let their FICO drop 10 points or something. But look at this data. Now, some of this data is being influenced by bad lending behavior. You look at the subprime auto market, that's a terrible market. It's just garbage. So I don't want you chasing. Don't lower your standards just to get market share at this point in the cycle. Be careful and be thoughtful as you do it. Now, people are very happy because unemployment's 3.7, and that's great. But as you all know, the worst loans are made at the best of times. You have loan officers in some of your banks, or people who assist the loan officers who are young. They're 30, they're 32, they're 28 maybe. They've never made a bad loan. They think they're smart. They're not. They're purely a victim of a good market. Being a day trader in 1998 was brilliant until it wasn't in 2000, right? I mean, you have to keep this in mind. They've never experienced a bear market. They're going to experience one sooner or later. That said, we're out of our minds happy. Because unemployment's 3.7, everybody's got a job, life is great. Small business is out of their minds happy. This is Trump's election victory right there. What did Trump promise? He promised tax cuts. Okay, we got tax cuts. He promised increase in defense spending. We got that. He promised deregulation and an overturning of essentially all of Obama's regulatory stuff. He got that done too. He promised to get rid of health care, Obamacare mandates. He's sort of done that too. He's getting there anyways. He's, you know, the requirement is gone, the tax penalty's gone, and so on and so forth. He hasn't done infrastructure spending. That's something that may come next election cycle if they can agree, but I think there's certainly a room for agreement. That may not be the most important issue for both parties. That's something else if the Democrats regain the House. We'll see. But Trump wins, and sentiment essentially continues to go up. August's number was the highest in the history of the series. September came out 2 days ago. It's the third highest in the history of the series. The series goes back not to 2000, but it goes back 25 years beyond that. It's 1975, NFIB data. So households are happy, small businesses happy, big businesses happy, we know that, right? They're buying back their shares with reckless abandon, doing lots of stupid mergers and acquisitions, which we know will fail at the end of the day, because like marriages, M&A doesn't always work, right? It looks great at the beginning, but it doesn't always work out. Increasing dividends, paying their workers more money. I mean, big business, happy. The stock market's at a high level. Everything is going like gangbusters. So what are we doing with our money? We're going on vacation. That's a pretty good thing. It's not a bad thing to do. Travel's a good thing for the economy. We're building lots of hotels. Hotel construction activity is very vibrant right now. It's not going up much, but it's vibrant. And hotel occupancy rates for 2018 are roughly on par with the all-time record occupancy rates of 2017. We're going on corporate travel, we're going on personal travel, we're going to theme parks, all kinds of good stuff. Totally frivolous purchases. But wait, we're not done. We're going to Vegas, for God's sake. What else says you're happy than Vegas? I was in Vegas 3 or 4 days ago. People are happy. They're throwing their money away at baccarat tables and craps tables, and they're feeling good about themselves. Why? Because unemployment is low, their stock market numbers are high, their 401k is good, their 403b is good, their wife's got a job, their kids are getting off the payroll, thank God, finally. Hopefully mine will too one of these days. I can't wait. She's 19, still in college. And the only reason it's ticked down a bit of late was about a year ago, there was a shooting that killed 60 people. That depressed interest in going to Vegas. They're going to other places. But as you can see here in the hotel numbers, there's been no dip in hotel activity. So that's purely a Las Vegas phenomenon. So things are good there. We're buying RVs. As I said earlier to somebody, who would want to buy an RV? I'm kidding. It's a great way to travel. It's inexpensive relatively. You can travel wherever you want, but they're expensive. And often you have to buy a truck to pull the RV. And if the RV has a car built in, I can't think of the right word for that, pardon me, motorhome, a motorhome, thank you, Bobby. You can't drive the motorhome to work because parking could be a problem, so you still have to have a car. This is a pretty expensive proposition, right? But we're buying them by leaps and bounds. Unemployment in northern Indiana, where they're made, is like 2%. It's crazy, northern Indiana. The signing bonuses and everything is spectacular. We're buying cars, a lot of cars, 17 million cars. It's not going up anymore, it's done. The car market's peaking now. It could stay there for a while, but it's not going to go up. So for states like Minnesota, where there's a lot of car manufacturing going on and car part manufacturing going on and suppliers and stuff, you're not going to see increases in supply sales and so on because cars are expensive, rates are going up, there's a lot of used cars on the market that have come off lease and so on and so forth. So the car market is slowly changing and used cars are becoming a little bit more appealing than they have been in the past because of the rising rates. And the cars themselves are expensive because I bet you old man, and you old man, you'd probably drive a four-door sedan, right?
Oh, absolutely.
Oh, absolutely. Nobody under 45 today drives a four-door sedan. I do. I'm the only other guy in the room that probably does. My daughter's embarrassed about it. Oh, Dad, can't you get a nice car? I have a car. No, we need an SUV or a crossover or whatever. So car sales are good. We're fixing our houses up. Why? Because we have lots of home equity in our home. And home equity loans are still very cheap by objective historical standards. And there's nothing to buy, right? You can't find a place to buy. So you own a house, you've owned it for a bunch of years, your kids go off to college, you're empty nesters with your husband, maybe you kicked your husband out, you're really an empty nester, and you gotta do something. I wanna buy a new place, nothing to buy. So you fix the house you already have. I'll drop 50,000 bucks, do a kitchen reno, or put a gazebo in the backyard, or a swimming pool, or something silly like that. It's like you can't find what you want, but if you spend enough money and you smoke enough weed, you can pretend you're happy. It's like that song, if you can't be with the one you love, love the one you're with. That's exactly how this mentally goes on with this home repair business. But nonetheless, you're spending lots of money fixing your house up, and that's good for the economy, right? And we're building houses too. We're not building enough homes. This is a critical problem our economy has right now. But we are building homes, and the builders would build more homes if they could, but they can't. Multifamily is in blue. It's doing fine, thank you very much. The problem is red, single-fam construction. You can see it's about 900,000. That's a level associated with recessions. If you go back all the way to 1960 and look at every time since 1970 when you've had a level of about 900,000, you're going into recession, out, in, out, in, out, in, out. Almost 10 years into a recovery, and we're at a recessionary low level in single-fam construction. Therefore, there's no inventory, prices go up, and that's really bad. And now people are running out of runway to buy a house. So you're seeing purchase activity, first-time mortgage purchases are flattening out. There's no growth year over year because no one's buying a house anymore. People can't afford. Higher-priced houses and higher mortgage rates are just simply too much after years and years and years of house price appreciation, going up much faster than wages are going up, have been going up. And you see refi activity deader than a doornail. If you have a refi office, just buy them a gun, buy them one bullet, let them play Russian roulette in the department over a month, and the last person alive gets like a bonus paycheck or something, Incentivize them to play Russian roulette or something, I don't know. What else are we doing? Oh my gosh, we're buying racehorses. Come on, tell me that's not a frivolous purchase. But the economy is so good. I could put up pictures of airplane purchases and on and on and on. People are happy, they have money, they have wealth, they have confidence because unemployment is low and therefore we're spending money and we're happy. But construction activity is kind of peaking out. You can see it here. Res construction's not really going anywhere. Private residential construction, private non-res, not going anywhere. So that's office space, warehouses, hotels, dormitories, all the other stuff. And that's public, it's going up. Governments are spending on roads and transportation. That's what's going on there, right? So that's nice news to see public construction going up, but not much going on there and not much going on there to fill out the background here. Now, let's change topics and look at corporate investment. Why is it doing well? It's doing well because oil prices are up. The U.S. is the world's biggest producer of oil, surpassing both Saudi Arabia and Russia. So now when oil prices go up, the oil patch gets excited. And they go, yes, let's invest more, and let's explore more. Let's build more ethane cracker plants. Let's build more refineries. Let's build more pipelines, and on and on and on. So when gasoline prices rise, in the past, it would dampen economic growth. Now it doesn't really dampen economic growth very much because the spending in the oil patch compensates for it, right? Because it's such a big thing, so it's almost a neutral effect on our economy, unlike up until 5 or 6 years ago when it was clearly a depressant effect on the economy. Next, corporate profits are ridiculously good right now. Banks came out yesterday with a bunch of profits. I mean, big money center banks, I get it. They're doing spectacularly. ROA of, our return on equity of 13% and 11% in some cases. Huge corporate profits. 20% is the expectation across the board for Q3, in part because of tax cuts, but also just because the economy is good and we're spending money on more stuff and buying more things and we're happy. And savings rates are still good. Savings rates are about 7%. So it's not like we're spending ourselves into oblivion. Households are not. They're being quite responsible here. Lower income households are going to have a hard time. They're the ones who are going to default on their car loans and their home loans when things go bad. And surveys of low-income households tell us they are already under stress. So I want you to be careful in that respect too. Don't say, oh, all households are good, we'll lend to anybody. No. I mean, you know that. You're bankers. You're conservative guys by nature. Here's data on ROE and ROA. So here's by banks by different sizes. All banks are in blue. The big money center banks are in black. Smaller banks are here, under 15 and under $1 billion are in red. And you can see things are generally dribbling up of late. Good news, right? Pleasant news, no problems here. It could be better. Higher is better, obviously, but not awful, right? Net interest, that was net interest margin here. Here's ROE, return on equity, dribbling up for everybody. The smallest banks in yellow, under 100 million. And then big banks in blue, over 15 billion. So these banks are, 150 times larger between the blue and the yellow, but they're all drifting up nicely. Smaller banks, as you can see, have consistently had lower ROE than the larger banks. Regulatory costs are involved, overhead, and so on and so forth. But they all generally go up and down together at the same time. It's just their ROE is just a little bit lower. ROA is the same story. The smaller banks don't do quite as well as the big banks, but nonetheless, everybody was flat here. Everybody went down. Everybody's improving now. So there's a differential between the big and the small, but that differential doesn't seem to be changing all that much. We could argue why that is. Are the very small banks merging up? Are the smaller banks getting more productive and more fiscally, not responsible, but more thoughtful in how they invest their money and how they do things, whatever. But the data seems to show that everyone's doing pretty much the same in terms of rates of improvement, right, which is important to think about. When you look at real estate, what's going on in the commercial real estate space, right? This is loans for commercial real estate. This is net percentage of domestic banks, you guys, reporting stronger demand for CRE with construction and land development purposes. Not much demand going on there. We know that because total demand we saw spending on construction activity earlier in slides was flat. Except for public, it was flat. And the public ain't coming to you to borrow money unless there's some public-private partnership or something like that. And this is how are the banks responding? Are banks tightening or loosening? Not much going on there either. So there's not a lot of demand and there's not much loosening or tightening of standards according to loan officers of the banks. This is for CRE. This is for C&I loans, right? So this is commercial and industrial. These are large, these are small. There's not much going on here. Not a lot of demand, a little bit of tightening there, but not much. So this is not particularly interesting space to look at. You got to look at it quickly to see what's going on, to compare yourself to others. But there's not a big story going on here. Not wild, big demand increasing or massive making it easier. Are you reducing lending standards wildly? Doesn't appear to be the case. Look at manufacturers. So profits are good. Households are happy. Small businesses happy. Big business is happy. Vegas is happy. Car sales are good. Racehorse sales are good. Manufacturers are thrilled out of their minds. Out of their minds, they're thrilled. The level, the higher the better. And it's been now almost 2 straight years that manufacturers are very happy with themselves, right? Stuff is flying off the shelves. Until recently, the trade issues weren't a concern. Even though the dollar has been rising over the last while, they haven't cared. They had almost a near-death experience in a recession, but they've come back with vengeance, right? So manufacturers are happy, but they're relatively small. They're just 10, 12% of GDP. How about the rest? That's services. They're ecstatic too. This series only begins in January of '08 when the recession starts. It's been essentially steady straight up the whole way. One hiccup here. A great series. Small business, big business, manufacturers, services, households, horse breeders, home builders are happy. Data came out, they're happy. Everybody's happy. The economy's good. It's easy to stand here and say things are great. The question is, when will they become not so great? So last but not least for this section, you can see corporate investment in plant and equipment has recovered dramatically. Equipment. This is just equipment, not plant. You can see how it's whoosh. Unemployment's low, wages are up, healthcare's up. You get the idea. It's leading firms to invest in equipment because they can't make more stuff. There aren't people to hire. And it's more favorable now to invest in plant than it has been in equipment in a good long time. But here's the catch. Things are good, but they won't last forever, and here's the first reason why. As I mentioned earlier, we had tax cuts in December, in blue, and we had spending increases that were deficit financed in February. 2 years, $200 billion a year for two years, so $400 billion total, in red. Right now, we're here. We're here, right? That's Q4. We're at the peak of the impact of all that fiscal stimulus. And in a year and a half, it'll all be gone. Right now, that's increasing GDP year over year by about, per calendar year, that's by quarter, right? By 0.6 of a point. We're gonna lose that 0.6 of a point. There's no question. It's automatic. So you've got to prepare yourselves for slower growth. I'm not saying bad growth, I'm saying slower growth. I'll tell you how fast in a couple of minutes. But we're going to slow down. There's going to be tighter monetary policy, there's going to be some trade policy issues, and there'll be some worker issues, and that'll all deaden a little bit of GDP growth. The other problem we face is when the recession comes, and it will be harder to get out. Because we're already going to run, this is fiscal 19, which started 2 weeks ago. We're running now very large budget deficits. We're late in a cycle. The last time we were late in a cycle was there with very small deficits. The time before that was there, we ran surpluses. That was also the last time unemployment was less than 4%. The time before that, when unemployment was less than 4%, we also ran a surplus. But now unemployment is under 4%, and we're running deficits that are over 5% of GDP. These are the largest deficits we're running outside of war, with the exception of those 4 years of the Great Recession. We're not going to have a lot of fiscal firepower to get ourselves out of the rut when we get into the recession in 2020 or 2021 or 2022, because Congress isn't going to have the money to throw and spend $1 trillion on a tax cut or deficit spending or whatever it is, because the deficit will get bigger because the economy will slow down, and we'll spend more on unemployment insurance and food stamps and all those counter-cyclical fiscal policies, right? Now let's talk about tariffs just for a moment. Up until 10 days ago, until September 30th, we had imposed tariffs of 25% on $50 billion of Chinese goods. Who cared? It didn't matter. The total impact to the US was 8 basis points of GDP growth. It didn't matter. But 10 days ago, we increased it to that plus now 10% more, 10% on 200 billion new products. Now we're bringing GDP growth down probably by something like 20 basis points. I'm noticing this is contractionary. Not only is it contractionary, but it's mildly inflationary too, because the cost of goods that are being tariffed are going up, and the Chinese retaliate and so on and so forth. This accounts for the retaliation. Fiscal policy becomes contractionary. Trade policy is contractionary. It all pushes down GDP. Nothing huge here, 0.2 of a point. I'm not jumping up and down, but it matters collectively. That's the issue. If you put it together, GDP growth is 3%. This year, it will exceed 3%. Q1 wasn't all that good, but Q2 was 4.3, Q3 that just ended probably 3.3 or 3.4, and this last quarter that was just started now, probably 3%. But it will continue to decline as we go forward because of all the stimulative effects that are going to slowly go away. And monetary policy becomes slows down. It still becomes expansionary, but much less expanded. It gets tighter and tighter and tighter and tighter, right? Why? Why can't our economy grow like it did here, right? That was Reagan. That was Clinton. That was W, and that's the recession coming there. But those were much better growth rates under Clinton and under Reagan, except for the recessions. This was stupendous for a little bit. How come so low? Why? Because we don't have the horses. Our economy fundamentally can't grow faster than roughly 2%. That's why I can stand here and tell you we will revert to 2% growth come 2020. Why? Population growth or employment growth is meager in blue, and labor productivity growth in pink or red is meager as well. Economists have no idea why labor productivity vacillates, why it does, so there's not much point thinking about it. But we know a lot about labor and people. We're running out of people. It's that simple. The number of births 55 years ago, 60 years ago, when you were born probably, a boomer, an older boomer, was 4 million. You know how many kids were born last year, Jeff? How many? 4 million, exactly. You're a genius, a demographic genius. How can that be? Our country's over twice as big as it was 60 years ago. But that means number of kids entering the labor market 16 years later is weaker. That's why the blue is no good. If you want to do your part to make America the best country on earth, go home and make love. Don't watch baseball. Don't watch football. Make love. And everything I understand about the process, I don't really know it firsthand. I've never experienced, like drugs, I don't know. I understand that it can be very enjoyable. So practice, work on it, and at the end, try and achieve a baby. We need more people. That's the way to get, GDP only goes up for more people working, blue, and the people who working better in red, and they're both weak. In terms of yield curve inversion problems, I'm not particularly concerned for the short run, certainly. So the yield curve looks like this, right? Years on the bottom, 1 year, 2 year, 3 years, 5 years, 10 years, 20 years, 1%, 2%, 3%, 4%, 5%. The longer you borrow, the more you pay. Occasionally the yield curve inverts and short-term money becomes more expensive than long-term money. It's rare, but every time it happens, the blue squiggle goes above the red bar. And every time the blue squiggle goes above the red bar, with the exception of 1965 or 66 here, it's been followed by a gray bar. What are gray bars? Right, you're very attentive, you all get an A. Inversion, recession, 2, lots of inversion 2 recessions, there again, and again. Will it happen now? I don't know. The Fed's going to raise the short-term end of the yield curve, we know that. 25 bips, and the next year another 50 or 75 bips. That may lead to an inversion. It depends if we get enough inflation and wage growth, which we'll talk about later. If we don't, the yield curve may well invert next year. By June, it's possible. The good news is the recessions, as you see, don't come immediately following the inversion. It takes 8-9 months minimally to get the recession to start. So you get an inversion in March or April, and you get 8 or 9 months later, a recession comes. Okay, 2020, I'm with you. So we could have a recession, I think, as early as 2020. There'll be other factors going on. The rising of the interest rates at the short end of the yield curve is going to also depress growth a bit, and GDP will be slowing because of fiscal policy that's going to become increasingly contractionary, right? And our labor shortages will get worse. So here, let's talk about labor markets, and you'll see what I mean. We used to create 3 million jobs a month at the peak of this recovery that we're in right now. We fell to 2, and then miraculously, we went up to about 2.5. So what you're going to wonder now is you're going to ask me, how is it possible? How can it be? I just told you we have no people, and you have to make babies. Our population growth was 4 million babies, last year, and 4 million 60 years ago. Where are these people coming from? How can this be true? And the answer is it's easy. We've run down the unemployment rate. The unemployment rate at its peak was 10%. And over the last 7 or 8 years, it's steadily declined to 3.7 now. 3.7. That's the lowest rate it's been since there. The slide's 2 or 3 days old. New data came out. It's down here right now. This was the housing boom. We're lower than we were then. This is the dot-com boom. We're lower than we were then. We're now here. Can we go lower? Sure, we can go lower, but not a lot. That's the way we've been able to create 2.5 million jobs a month for the last 2 or 3 years, despite only allowing 100,000 people, not allowing, having 100,000 people a month or so enter the labor market. It bursts over desks, entrance in the labor market, minus retirees, college dropouts and high school graduates coming in, people who are making millions retiring in Silicon Valley, whatever. We're creating about 1 million more jobs than we have people. This cannot continue. It has to stop. Now, there are extenuating circumstances here. Uber, for example, has rearranged this data. No one knows how. But in the past, when you were unemployed, you had to look for a job, and that was hard. Now, you download the Uber app, and you're working. Literally, or you sell your stuff on eBay, and you're working. So the definition of work and the measurement of unemployment is different than it was. There's no real good data on this out there. Economists are struggling. It means unemployment can be lower than it has been in the past without causing inflation. So the natural rate of unemployment, or how low can unemployment go before inflation takes off, used to be thought to be in the low 4s. Maybe now it's in the low 3s. But we are going to soon approach the level. There's no question, at which point we'll run out of workers. So this is not a problem for today, but it's a problem for a year and a half from now. We'll be out of workers, right? Look how happy workers are. They're quitting their jobs with reckless abandon. 2.4% of the labor force quits their job every single month. So you may be a lousy manager, but 30% of your workers quit anyways. This is manufacturing employment. It's gone up nicely, but it will get increasingly hard. Manufacturers now complain. Construction industry complains. Everybody complains they need workers, right? What's the biggest problem? Job openings are hard to find. It's starting to slow us down now. Firms can't bid on contracts because they don't think they can find the workers. This problem is not going to go away. It's going to get more severe because our population growth isn't occurring and we're running out of workers because the unemployment rate's getting very low. You would think wage growth would be spectacular under these conditions. I mean, everything's perfect, right? Economy's chugging along. He's going to get a new job. The guy's walking out right now. There's some old guy. He's a boomer. Doesn't need to hear me. Oh, he's getting coffee. Sorry. So wage growth has gone up in the last 8 years from 2%, essentially, 1.8 to 2.8. Better, but not great by any stretch of the imagination. By any stretch of the imagination. Why? First of all, there's aging going on. Old people like Doyle there who's snoozing. I'm kidding. He's probably texting, twittering about how awesome this economist is who's speaking right now. I'm joking. He's retiring, on the verge of retiring. He's making $500,000 a year. He's being replaced by you. What's your name? Delmarie, who's 22 years old, just finished college, starting your career, making $40,000. So he's making $500,000, you're making $40,000, and mechanically that lowers average wages. If you account for that effect, the 2.8 roughly becomes more like 3.4. It's better, but it's flat. It's not really going up. Wage pressures just aren't like they used to be. Maybe it's because, this is job quits. If you stay in your job and you're a loser, that's your pay raise rate. If you have gumption, and you tell your boss, take this job and, look how much better that gap says we have an employment shortage. The gap here says we have an employment shortage. The gap here says we have an employment. When the gap gets big, you end up with a recession. Big gap, recession. Big gap, maybe a recession. The gap is not what's causing the recession. It's the fact that you're running out of workers, which causes inflation to go up, which causes the Fed to raise rates. The Fed's overzealous, they raise rates too much, they drive us into recession. How exciting is that? I'm kidding. Maybe it's because there aren't a lot of unions. No one agitates for pay raises because no one thinks of inflation. There's no need to push for inflation. We haven't had it in so long. You're old, you remember in the 70s, but nobody else does, right? Nobody else does. We're all youngsters now. There's the Uber economy, which I talked about. That depresses inflation too. It brings people into work, and it also depresses inflation. Cost of a cab ride, lower. Transportation for goods and goods, it's free. 20 years ago, it was Walmart and China that brought prices down. Now it's Uber and the web that are bringing prices down. So that's deflationary tendencies. It reduces inflation. But inflation's coming, I promise you. It's incipient, it's mild, but it's coming, there's no doubt. This is the CPI, what you think of as inflation, right? Blue is headline inflation, red's core, no food, no energy. You can see blue really bangs around because blue is affected by oil prices, which are affected by war or deals with OPEC or China or Russia or something. And food prices go crazy because of a drought in Saskatchewan, bumper crop in Iowa, or problems in Ukraine or something silly. Economists don't look at blue, they look at red. It's going up, that's pretty clear. It went down last month, but it's going up. The Fed doesn't look at this measure of inflation. Rather, they look at the PCE, Personal Consumption Expenditure Index. It's a little different. Outside, I'll talk to you about why if you really want to know. The point is, just like CPI, it's going up. Not fast. The Fed wants red core PCE to be 2%, and guess what? It is at 2%. It's the first time it's been at 2% since there for a few months, and before that was end of 8. It's essentially the first time we've had 2% PCE inflation in a decade. The Fed's happy, but the inflation is occurring, and the Fed wants to get ahead of it, all right? Because they know that monetary policy has a lag period of 9 to 12 months before the full effect of monetary policy takes place, because people have to refinance their properties and so on, and they don't feel the full effect of the interest rate hike for a while, or they were planning to buy a car because their car got old, and then they still go through and buy the car. Rates get too high, they then say, you know what, I'll fix the car instead. So you can't wait until you see all the inflation before you raise rates. It will be too late. But then there's the fear the inflation doesn't actually materialize. That's the problem the Fed faces. They don't know what's going to come down the pike. They know their effects today that they raise rates will have bigger impacts over the next 12 months. They don't know what the next 12 months will bring exactly, right? It's a guessing game. They're smart, but they make mistakes. Last but not least, look here. This is how fast our economy ideally grows in blue. This is how fast our economy actually grows or is size in red. Notice we have a recession, there's a gap, and then it shrinks. We have a recession, there's a gap, it shrinks, a recession, a gap, it shrinks. Good news. So we get rid of the recessionary problems, we compensate for it, we grow faster, we catch up. Look at the graph the other way around now. Right before the recession, red improves and touches blue. Red improves, gets bigger than blue, and we have a recession. Red exceeds blue, you get a recession. Red, actual growth exceeds potential growth, and we have a recession. It isn't that the red breaking the blue break causes the recession. It's we begin to have inflationary pressures. Commodity prices, except for ag, goes up. Interest rate pressures go up, and the Fed starts to raise rates, and they drive us into recession. This is what's likely to happen now. If you look back at interest rate rising cycles, 2/3 of the time it ends in a recession because the Feds just raise rates too fast. Am I fearful they'll do it again? Sure. Do I know they will? Absolutely not. Hopefully they won't. Maybe they'll get lucky. We'll see. What are rates going to do? First of all, the obvious. The taller the Fed chair, the higher the interest rates are. It's obvious. Powell was clearly too tall, clearly a mistake. But we do know this. Fed funds is currently between 2 and 2 1/4. By the end of the year, they raise it to 2 3/8, 25 bip increase. Next year, the big fighting is, do they raise it twice or up to 4 times? That's the big question. Who really cares? Unless you're a big bank doing all kinds of crazy arbitrage and hedging strategies and straddles and options, this is not a big interest rate story. We're not going to have massive increases in rates because a year from now, our economy will not be growing so fast. We'll be approaching 2%. We'll be at 2.5 or something, slowing down. A slow economy can't possibly have high interest rates. And the Fed's not going to let inflation get out of the bag. If you don't have high inflation, you don't have high wage growth, you don't have high GDP growth, you can't have high interest rates. Because if you do, you'll drive us into the drink. The Fed's cognizant that they don't want to invert the yield curve, they don't want inflation to get out of the bag, and they don't want our economy to go into recession. So they're very hemmed in here. You see in the minutes that came out yesterday from the meeting 3 weeks ago, they said, some of them said, we have to raise rates faster to dampen inflation. Other guys on the Fed say, no, there's no need to raise rates that fast because I don't think the inflation will show up. The next rate raise in December is going to be easy. The next rate in March will be easy, and the next one in June will be easy. And then it gets hard, because by then you're already at 2.75. The economy is probably starting to slow enough to notice, and the Fed's going to say, do we raise, do we not? It depends on inflation, and it depends on wage growth. If those go up, they'll push interest rates up. If they don't see it, maybe they'll cap it for a while. We'll see. I don't know. By the end of 20, who knows what will be. Absent, if no recession comes, they'll have to keep raising rates a little bit. That's got to be the highest rate it will get to, because GDP growth will be low by the end of 2020. We'll have inflationary pressures on one hand that they'll be trying to dampen down with the higher rates, but there won't be much GDP growth. The Fed has to get job growth down to 100,000 a month. That's their job. If they cannot get it down, inflation will get worse. We're only producing 100,000 people a month. They have to get growth down to 100,000 people a month in employment numbers, whatever GDP that results in, because otherwise the inflationary pressures are going to take off, right? How about things, let's talk about here, and then we're going to wrap it up. First of all, I don't care how much you think you love your place, be it Wisconsin, right? You're a Wisconsin, or you come from Minnesota. Great places, but nobody else wants to live there. If you look at America, it's a big funnel. Everybody who lives in the funnel area leaves, and they all move here, and they move there. They move here because it's cheap. They move there because it's expensive, but it's beautiful. Weather's great, taxes are super high here, lower there. Here there's tons of jobs, low regulation, low property taxes, low income taxes, and there it's beautiful. And here it's neither. Winter's terrible and taxes are high, but you love it, I know. Next, to keep in mind, the Bloomberg Index, this is index for agricultural commodities, it stinks. To the extent you're involved in ag lending, God bless you. These guys have lost money for years. I don't know how they keep doing it, quite frankly. They're putting away their 401ks, they're sucking money out of this, they're selling their birthright, they're selling their wife's jewelry. I mean, it's a serious problem. It dampens growth. But your states, Wisconsin, Minnesota, are beyond ag now. You're much bigger states, you're much more diversified. It's a problem, but it's clearly not tragic, right? Farm income, as you can see, is very weak. Net farm income today is what it was 10, 12 years ago. This is a problem. Will it get fixed? A lot more countries are involved in ag now than before. It's not just the US, Canada, Australia, and Russia. There are a lot of nations involved in the industry now. Cattle prices are weak. You're involved in cattle. Corn prices are weak. Not particularly good. Hay prices aren't doing particularly spectacularly. Milk prices aren't doing particularly well. It's hard to find a great story in agriculture. Soybeans, there's nothing really. This is November futures contracts, not doing particularly well. The soybean crop has been spectacular. There's much too much soybeans. Stocks of soybeans are way up. It's a very bad thing, depressing prices. So I don't see this problem going away tomorrow unless we have some terrible weather abroad. Never in America, but let's hope it the Europeans and the Canadians or something, right, and the Australians. Wheat prices are going nowhere. They're back where they were again 10 years ago. Costs are up, but not prices. Gross domestic product, however, because these states are beyond it, Illinois is here as well, are beyond it. Minnesota is clearly the best in show here. You can see they're generally the highest producing in terms of GDP growth. Your rate over year growth is generally the best of all three of these states. Congratulations to Minnesota. If you look at coincident economic indicators, they're good for all these central US states, right? Upper Midwest states, they're fine. Minnesota's the best, Wisconsin's a bit weaker, but they're all fine. And the color palette's good, avoid Maine. Leading economic indicators are good too, they're all the same color, they're all fine. There are no real problems. Our economy's good. We're growing nicely. That's the key. GDP growth has been good, and that solves a lot of the world's woes, right? In terms of unemployment rates, oh my gosh, except for crummy Illinois. Don't go to Illinois. Don't even email friends who live there. You will get a disease, an economic disease called a recession. I'm telling you now, don't fly, don't drive, don't email. Hermetically seal the miserable state of Illinois. But Wisconsin and Minnesota, 3% unemployment. That's well below the US average, well below. Well below. You are running out of people. Labor force growth in Minnesota is particularly strong. It's good in Wisconsin, but not quite, and it's horrible in Illinois. Illinois really stinks. Don't go. Last but not least, payroll growth. Again, Minnesota in red is the best. Wisconsin's not bad. Even Illinois is not bad in payroll growth. The problem is they have no people to hire. That's their problem because taxes are high and they're all moving to Indiana and Wisconsin, right? And last but not least, house prices are going up and recovering everywhere. And of course, in Minnesota, they're at record levels. In Wisconsin, they're almost caught up. In Wisconsin and in Illinois, they're almost caught up, right? Let's wrap it up here. My name, my cell number, website, Twitter handle, email address. I put out 70 words that you were gracious enough to talk about earlier. If you want to sign up, give me your business card, go to my website, Econ70, or text the word bowtie, no hyphen, no space, to 22828. The economy now is fine. It will slow down. It will take a while to get there. GDP will fall from where it's been, 3.5%, 4% to 2% over the next year and a half. By 2020, we're growing at roughly 2.2%. The slower GDP growth is, the higher the chances of a recession. Come 2020, the probabilities of recession go up enough that I begin to get nervous at this point. In 6 months, I may kick it out another 6 months or a year. We'll see. But that's the earliest time I realistically expect us to see a recession. I hope I've given you some food for thought. It's been really a pleasure being here. I could go on for hours. I'm sorry I can't. Thank you, thank you, thank you.